To be here with a distinguished panel here, which I'll be introducing one at a time very briefly before we get into some questions. So let's start with Alexandre Guertin. Alex is an associate with Kensington's venture capital investment team. He began his career at L'Oreal before launching several innovative ventures, including a sports supplement company and a clean tech company that went on to raise significant funding. Alex joined the venture capital industry first at the BDC, or Business Development Bank of Canada, and then at TELUS Capital, two of Canada's largest fund of funds and venture capital investors. We have Jennifer Hamilton, Senior Director, New Ventures at J&J Innovation, where she is responsible for scouting and evaluating pharmaceutical, device, and consumer technology opportunities in Canada. She also works with J&J's Global Health Impact Investor Group. Finally, Jennifer has worked as an advisor to early and late stage companies, venture funds, and pension funds, giving financing, business development, and M&A advice. Then we have Dion Madsen. Dion, welcome. Dion is currently Senior Managing Partner at BDC Healthcare Venture Fund. He has over 20 years of senior management experience as a financial executive and venture investor. Prior to joining BDC in 2013, he founded and led Physic Ventures and was Managing Director of Unilever Technology Ventures. In addition, Dion is also a member of the selection committee of the San Francisco Canadian Technology Accelerator and a founding member of the C100, a grouping of Canadian CEOs, if I'm not mistaken, working in Silicon Valley?
Yeah, that's right.
Okay. Then we have Rich Osborn, Managing Partner at TELUS Ventures. Richard is a Managing Partner, as I said, of TELUS Ventures, the strategic investment arm of TELUS, a leading Canadian telecom company with advanced offerings in health IT, IoT, security and privacy, and fiber to the home. Before joining TELUS Ventures in 2016, Richard was the founder and managing partner of Recap Health Ventures, a leading Canadian-based investor in North American healthcare companies. Last but not least, Maria Pacella is currently portfolio manager and senior VP private equity at PenderFund Capital Management. Maria has over 16 years of investing experience in emerging growth companies with a focus on the tech sector. She spent 11 years with one of Canada's largest venture capital firms, where she invested in multiple early stage ventures and served on a variety of boards, mostly in the areas of enterprise software, e-commerce, and medtech. So thank you all for joining us this morning.
That's all the time we have. Thanks very much.
Any questions? All right, so we're going to start with a very general one. Alexandre, perhaps you can kick us off. Can you just comment in general on some of the current investment trends that you're seeing these days, particularly at the seed stage?
Hi. I joined Kensington this year, looking at the Vancouver market and BC in general for Series A investments. But we see a lot of seed stage opportunity in Vancouver, lots of promising companies. What I see is that the angel community in Vancouver is quite active. There might be some missed opportunity in terms of seed stage capital fund here in the province, but I think like the angels are really good at picking up the slack there. I think it's a vibrant community, and there's a lot of capital available for early stage companies. At the Series A level companies I look at, I'm always happy when I see a lot of early stage fund and angel investors that have backed multiple of great companies, because it provides a good funnel of opportunities for me. But yeah, I think it's a very good market right now to raise a seed round.
Excellent. Sorry, yeah, please.
I think one trend.
A little closer to the mic.
One trend I'm seeing in both seed and Series A is the money's kind of moving later, and what I mean by that is the companies themselves. Rarely, it's much more rare to see kind of a simple concept and a couple people getting funded. Even angels are looking to see some validation, if not revenue, but at least a significant partnership deal that shows that there's a path to some revenue, some validation. And so that's true, I think, for angels, both south and north of the border, much more south. For sure, the money's going later, as well as VCs too are going, putting money into later stage.
Dion, do you have anything to add?
Yeah, I think just to pick up that comment, with those more mature companies, I think you're seeing a sort of friends and family rounds, taking it to a certain proof of concept, and then a very large Series A that is built upon that proof of concept. And that Series A then is used to really scale a company quite rapidly. So we were seeing Series A rounds like, we did one recently with Jarrell that raised over $50 million US in a Series A round, which would have been unheard of 10 years ago, doing something like that. That would have been like a Series C. But you're using it to attract the best intellectual property and the best management team and move very quickly.
Yeah, just one last thing to add, I guess. I'm assuming everybody here has kind of got an interest in health, so there's this super convergence of healthcare investment. So whether it's AI or blockchain, a lot of technologies are being positioned or directed to solving problems in healthcare. So what's happening in the seed stage is you're getting a lot of, call it the long tail of investors. You're getting a lot of investors who have not historically done healthcare deals, who are now starting to enter it kind of backwards, coming from a technology first and then figuring, oh, let's get into healthcare as a secondary issue. And so I think that's I don't know if we're going to talk about it later, but the Paul Geyer's comment, I think it's a tough industry to kind of drive by. And so if you're an entrepreneur in the crowd, I don't know if you are, but be very conscious that fit's important, the no asshole rule, all that. But if you don't have an investor who's got some, let's say, long history in healthcare, more than a few months, I would be very, very cautious.
I want to leave you out.
I just have one more comment. I think the greatest trend is that the investors are here again. It's been a long time in Vancouver since we've had such a great panel here, and others in this afternoon as well. We've had a very, very bare period, and it's nice to see them back.
Excellent. Great. Second question. Particularly at the seed stage, are there any other types of either new or older, but people don't know about it, some funding sources that exist today for companies here in BC? Perhaps non-dilutive. I'll leave it open.
I don't know if there's anything new. I mean, what's old is new again. I mean, I think that the junior capital markets are, the mining guys are looking for things to do, as they tend to do every 5 to 7 years. So lots of public stock, and there's some people who are, I think, doing a better job of marketing those options for early stage companies. I think the angels, I think there's some non-dilutive sources, a lot of Shred and IRAP and ITC, and I think I see some folks from those organizations here in the crowd. So, but I wouldn't say those are new.
For those who might have come up from Seattle and Silicon Valley today, some of those might be new, and some of the advantages of investing in Canada. Anybody else?
I don't know if it applies for life science, but in clean tech, SDTC has a very large mandate to fund proof of concept, so they can provide non-dilutive funding for up to like a third of the value of the project. So I think that's a really good source of funding for a lot of companies that want to demonstrate before they go commercial.
Anything else, or we can go on? Okay. Perhaps this one, Jennifer. Given your experience at Johnson & Johnson, can you provide some insight into, for startups that want to work with corporates, strategic investors, and innovation partners? Why would they want to work with J Labs?
Right. So that's another source of financing for small and seed companies is corporate investment. And more pharma especially is looking outside for their innovation, and they're very happy to do deals at a very early stage. And not always a deal that involves options or tying up your technology, but sometimes just a pure collaboration that has no strings attached. And you alluded to the J-Labs model. For those of you who don't know, this is part of J&J. It's our incubator group, which is located in several sites in the US, but is also now located in Canada and Toronto. And it's, again, a no strings attached model where you can come and pay rent to be part of our incubator and share space, share equipment, and have all kinds of mentoring. So that's another way that industry is getting involved with helping startup companies.
Any challenges or pitfalls that startups should consider when looking at a strategic corporate partner?
Well, I guess you don't want to tie up all your technology to make yourself unattractive to investors.
Yeah, super, thank you. Anybody else have something to add on that one?
Well, I was just going to say, you phrased the question as why would you, and I sort of brought it back as why wouldn't you? As an entrepreneur, the corporates are all quite well behaved now. In fact, they have way more to lose from trying to steal your technology than you have of them stealing your technology, because they have huge asset bases you can sue them for. And they typically can't move very quickly, but they're really looking to try to access innovation and new ideas, and they're very willing to help out. I think J&J's got one of the leading models around innovation, where they're willing to just engage with these companies to see if there's a proof of concept, and is there a there? And if there is, then they're very willing to talk to you. So you can get access to world-class experts that you could never reach. You could get validation of your technology and its attractiveness very early on, and potentially non-dilutive capital. So I look at that and go, oh, why wouldn't you want to?
Maybe I'll just top up as the other corporate here. And for those of you from south of the border, TELUS is one of our largest telcos. So it's not intuitive, but we're actually the largest health IT company in Canada as well. And we have a pretty dominant position in primary care and pharmacy and claims management, disability management, transaction processing. So we've spent about $2 billion over the last 8 or 9 years in that space developing that footprint. So I think one of the advantages, if you were to partner with us, whether it's from financial or distribution or what have you, is we can give you that distribution and that reach and the customer validation, access to about half the doctors in Canada, et cetera. So that's clearly one. The other thing is, I can't claim we're on the same level as J&J, but we're trying to be really thoughtful about how we do innovation. So our team's kind of got that mandate, and one of the things we've done is we sort of looked at what happens in the venture world and the incubator world, and we've tried to take some of those best practices. So as an example, we're in health specifically, we're doing it across other lines of business at TELUS, but within health we took 4 areas, so pharmacogenomics, consumer health, a digital health platform called the TELUS Health Exchange, and primary care, and we kind of brought in entrepreneurs and residents in each of those areas and said, just go come up with some ideas. And give them some walking around money, and we've launched 2 of those initiatives and brought in general managers to kind of launch those as separate standalone business units. The last thing we'll do, just for those of you who are here, the last thing I'll mention is we back something called First Step, and it's run by a guy who's our Chief Innovation Officer on the healthcare side named Dr. Brendan Byrne. He's an entrepreneur, started an EMR company, a great guy if you don't know him. But what First Step is it sits with companies of all stages, mature ones, early stage ones, and it basically talks you through in a guided discovery process, what are the market forces in your sector? What are the things you're aware of? What maybe some of the things you're not aware of? And I've sat in on a bunch of them, and it's really fascinating just to kind of have this, because usually you come into a pitch meeting, the VC, right, and they say, well, tell me your economics and tell me your revenue model, what's your go-to-market, your financial plan. And this is like, don't tell me any of that stuff. Don't tell me anything proprietary. Just talk to me about how you think the market's going to develop. And we've done it now with about 40 companies. And so you're starting to feed, kind of best, I guess, learnings about large market forces back into the startup community. And it's I think beneficial for them. And we know it's insightful for us just how the smartest people are thinking about things.
Excellent. Thank you very much for that. Dion, perhaps you can tackle the next one. Can you talk a little bit about the pros and cons of various investment structures, such as convertible debt versus equity, common versus preferred shares, and so on? And then while you think about your answer, are there differences on this side of the border versus south, like in Seattle or Silicon Valley?
No, I remember I volunteered for this one. So I think probably, given this is an early stage forum, the big question early on is, should I do an unpriced convertible note, or should I try to do a price round, try to raise common stock, or should I sell preferred stock, and so on. So I'm going to speak a little bit from my perspective of the view of the capital structure when we take a look at it, but I think that we view the convertible notes as not necessarily a best way to go, because it ends up putting off a discussion that should be had into the future. And the hope of the investors who are buying your convertible stock is that the company's price is actually much lower than management expects in the future, and then management is hoping that it's much higher than the VCs expect. So you're sort of putting off a discussion where you know that people are going to have differences of opinion at some point in time. And I feel like that's kind of an immature approach to it. And I know it's super popular and everyone does it, and it's just because it's easy and we don't want to have that difficult conversation. But it ends up creating some issues down the road when a round emerges, the company's had its sort of predictable hiccups in its development, a new round comes in and it's priced much lower, and the entrepreneurs are going back to the original investors and saying, oh wait, you had some price protection in here, you had something that kicked in. This is going to be hugely damaging to us and unmotivating to us. And you say, well, look, we told you that beforehand, but you didn't listen. So I feel like you want to try to create from the beginning as much of an alignment as possible. So you should really be thinking about doing something quite early on, and even just doing a price round, but something that's done at a reasonable price where there's some expectation that the entrepreneurs are going to see an increase in the value of their stake, the early investors are going to see an increase in the value of their stake. It doesn't create any kind of barrier or burden to you when you go out and refinance later. So that's my personal view. I'd love to hear everybody else. The second question that typically arises is when you do that round, we see a lot of entrepreneurs coming to us and say, oh, we only want to do a common stock round, and we want to vest all the shareholder rights in the unanimous shareholders agreement. And typically then a bunch of shareholders will get around and say, okay, well that's fine, we understand how you guys want to do that, but we want to have a veto on the next financing round. And you go, okay, that's fine, you know, as long as we get our common stock, we don't give you any preferred stock, we're fine with that. And then you go to do the next round, and somebody says, I don't like the terms of that round, we're going to exercise our veto. And you go, oh, now we're screwed. Or you have such a high voting threshold to capture everybody that you can't get anything done. So I really prefer just being transparent and embedding the rights in the preferred stock and issuing that in the preferred stock, because then those rights can easily be taken away at some future point. When they're unanimous shareholders agreement and you have a super high bar like 90%, it's almost impossible to get rid of those things later. So just being thoughtful early on about how you set it up.
Just the last comment as a follow-on. If you're a founder and you're heading down to Seattle as well, like you've checked out the investment scene here, you're going to go down to Seattle. When you're dealing with an angel investor or VC on that side of the border, are there any differences in terms of offering common stock? Because I heard that there's some potential tricky situations you get into if you're not talking the same language as the American investor.
I'll leave that for these guys because
Okay.
Most of the deals that we're doing are Canadian-based.
Sure. Anybody else encountered that? Or?
Yeah, I mean, I think it's funny, I was talking to a guy who's done angel deals, and he said 65 from Canada to the US this morning. He'd never seen a common share deal in the US, ever. He says it's all the rage. So, you know, I wear it personally, I think like most people have two hats. So one is, as an angel investor, you know, you do a common share deal, or you do a SAFE or a convertible note, to Dion's earlier points. I agree with everything he said. And you kind of go, you know, it's not my core business, or I'm too busy, or whatever it is. I'll kind of punt on the valuation question, or I'll take the common just to kind of get things done because I like the guy. It's kind of call it a non-professional approach. But on the other side, if I'm wearing the TELUS Ventures hat, it's got to be a pref share deal. And more to the point, I think, just to call out the venture capital community for a sec, like, if our core job isn't in part pricing risk, what the hell is it? Like, if you can't come up with a value for a business and you want somebody else to set it, like, it feels like you're kind of punting on one of the core components.
Good point. Okay, great. Let's move on to the next one. Alexandre, perhaps this one is for you. What are some of the important criteria that you look for in a startup when making an investment at the seed stage?
For me, it's all about the team. The business might change through times, but if you have a great team, great people, business might be able to pivot in the future, but it's all about the team. So yeah, 100% the team.
Excellent. I'll open it up to anybody who wants to contribute on that one.
I'm not speaking from an investor standpoint, but for investing in technology standpoint, and we really need to see what the differentiation is of your technology. What's unique about it? How does it compare to your competitors? That's usually forgotten in the investor pitches.
On the flip side, what are some of the key pitfalls that founders and people going after venture capital money when to fail in getting what they're looking for? What is it? A pitch or?
When a company tells me that they are the only one in their market. And those nice chart where they're at the top right corner and everybody else is in the bottom left. So if you don't understand who the competition is, that kind of scares me.
Or if this is their last round that they're going to do.
And, you know, I think when they haven't done their homework on who you are, you know, if this has been a space or a stage that you invest in, I've seen that more often, not still. And I think looking at the skill set of the team, what's really important is if you don't have a team that necessarily fits with the market opportunity that they're going after, that's, you know, you kind of ask, how did they get here? What, you know, what's the story?
The one question I think in healthcare you gotta nail, like, is who pays and why. And if you can't nail that right away, you got tough road.
That's a major issue for health IT companies, right? You might have a great technical solution, but who's gonna actually pay for this thing? So-
Yeah, that's a major problem for all healthcare companies. It used to be, you just got FDA approval on the drug side or the medical device side, and it would sort of sell itself. And today, it has to come with a pharmacoeconomic analysis around proving value, and you have to show everyone in the value chain making money, the patients, providers. You know, the patient has to get a benefit, the provider has to make money, the payer has to see savings. So that's critically important to understand that right at the beginning. I would say, you know, given that we have a number of entrepreneurs in the room here, is that I think what the VCs are looking for is honesty. It's okay to say you don't know the answer to a question, or, you know, these are the things that we need to learn before we can answer that question, and this is the step that we're going to take. It's important to say we have competition, and this is where they're strong, and this is where they're weak, and this is how we're going to tackle that. But just be honest, and you're not going to snow us. You might snow us in the first meeting, but then in diligence we're going to figure it out. So, you know, what's the point of that? Like, why would you waste people's time by selling them on one thing that isn't really true? So just be really honest. And I would say in that pitch meeting, what you want to get from the VC as well is you want to get their best questions. You want to give them the information you have, and you want to get their input back, and then take that and refine your, not just your pitch, but your whole business vision and idea. And sometimes they're totally wrong, but having them challenge you and make you think about a different market or a different approach is always useful. And the VC might be totally out to lunch, but the process of them challenging your preconceived notions is always very useful.
Great, we have about 5 minutes left, so I'd like to open it up to the audience for questions, if anybody has any. We could pass around the mic. We have one at the back. You want to yell, or do you need a microphone?
Hi, I was wondering, nobody mentioned adoption as an issue, and so I've seen a lot of good deals get lots of funding, especially in the US, and then kind of falter because they don't know how to get actually change what they do. Is that at all something that you consider when making decisions?
I'll tackle that. I have a lot of experience in that, unfortunately. The entire healthcare IT market is really challenged because there's very long sales cycles. So being able to get traction there's a recipe to it. It's essentially, you know, get a couple of key reference clients, build on those reference clients, sell into that marketplace. It sounds simple, it's hard to do. And I think it can sometimes, both from management and an investor standpoint, you can overestimate the value add of your product and underestimate the complexity of the selling process. So generating adoption can happen through, you know, a different target. If you're going to target the hospital sector, you have to be prepared 18, 24-month cycle and lots of fits and starts. But really understanding what the problem is that your product solves, and every other piece of technology that fits within that is critically important. And I think we're still not very good at understanding that, especially as Canadian entrepreneurs who don't have as much experience of selling into a US system as they might have experience in dealing with a Canadian system. So I think it's a major challenge.
I would answer it this way. I would say there's different types of healthcare. So there's call it pure health, make up whatever terms, health, and then there's wellness, and then there's something called betterment, right? How do I run a faster marathon? Wellness being, certain ameliorations, and health being the deep acute care, primary care interactions. As you move down from health to betterment, I'd say price and revenue and the economic model becomes less important, and having the ability to drive behavior change becomes more so. So it really depends what category you're talking about, but it is a truism. It is the hardest thing in the world to get somebody to change their behavior. One of the interesting companies, a friend of mine's an entrepreneur. He started a company called Nurse Next Door, which is a home care, very successful home care business. His second business is called Live Well. This isn't an ad or anything, but the essence of what they're doing is it's gyms for people who don't go to gyms, right? You haven't been since grade 6, you go to this place called Live Well. And they have distilled down what it takes, the actual Herculean effort to get somebody to change their behavior. And a lot of companies just leap over that and go, yeah, we'll sell them this app and everything will be great. But it's really, it's hard.
Thank you. Maybe one last thing before we close. Perhaps one tip from each of you for the companies that'll be pitching here today. What is your advice? If you have to give them one tip. Maybe start here. And
Great. I can't think that fast. Well,
this was not canned, so you have to think fast.
I'll sort of steal from Dion and sort of just be honest and open. I think that's key.
Recognize that it's 30% the data and what you're saying, and 70% about how you answer questions, your thought process, your background, etc.
What's the path to exit?
Real clear articulation on what pain you're solving.
And I think for me, it's more important to understand what the vision is. So, how big of an idea is this going to be? If you want to attract venture financing, they're looking for things that have the possibility of scaling. So, what's the big idea? It's important to know that you know what's right in front of you, but also that you have a longer term idea about how to grow the company into something really meaningful.
That's a collective $1 million answer. Thank you. So everybody, a big round of applause for our panel. Thank you very much.